Good day, everyone. Well, as you can see, the markets are having a pullback of some sort, dragging down a number of leading names as usual, with the S&P and the Dow right at their respective 10-day, rather 10-week moving average lines. The nature of the pullback is fraught with a lot of distribution days, even leading up to this pullback, and so with the leading stocks dragging along in this uptrend, it seems that the odds day by day favor a continuation of what we're seeing here in terms of the nature of this pullback and how much further down it could go. We have seen a number of short sale setups set up nicely and work, and should this downtrend continue, there will probably be additional such shorting opportunities. It's interesting that Bill Gross of Janus Fund used to head up PIMCO, which is the world's largest bond fund, and he writes monthly missives, and this month was interesting because he's seems to have changed his direction. I thought he was anti-QE because it's destructive in the long run, but in this one he mentions that he's all for a helicopter bend, so to speak, helicopter Bernanke and Yellen and the Fed printing more and more money, and then it seems like there's a vested interest on his part because he sits on a lot of bonds at the Janus Bond Fund. So naturally, he would want the central bank to go ahead and continue to print, so that would continue to lower rates, or at least keep them low, and that will help his bonds, or at least help him unload some of his bonds at a profit. So it just struck me that you can't necessarily trust the information from even a leading bond guru such as Bill Gross, because he might have an ulterior motive at hand. That said, these central banks that continue to print around the world, Japan interestingly halted, well, it didn't halt, but they halted their continuation to move more negative, so they didn't do anything, and that was upsetting to the markets. And that might send a red flag out to other central banks that you don't want to go negative, or you don't certainly want to go more negative than you already are. Switzerland, and I believe, is negative right now, and it can create a lot of issues down the line for the respective country via pension funds and insurance companies and whatnot. So at any rate, we're seeing that the global economy is still in trouble. There's no evidence that it's been turning around whatsoever, and these central banks are at their wits' end, it seems, to try to get things jump-started, but they're going at it from a wrong principle of trying to create inflation, but the key is creating demand inflation. But what's happening is people are hoarding their capital, they're hoarding their savings, and they don't trust these governments and their respective economies. So that's what people do when they don't trust the environment. They tend to become hoarders rather than spenders. And we've seen this time and time again throughout world history. So I guess the question is, what's next? And right now it seems like, given the number, we've had two substantial corrections just in the last couple of months in the major markets, and this is the first time that's happened since the QE program began in in 2009, it began in earnest. And it does seem like this QE train is starting to exhaust itself. So, in other words, as I wrote at the beginning of this year, expect heightened volatility throughout this year as the loss in confidence starts to accelerate. And you can see that also partly in the price of gold. That is a fear trade of sorts, and you also see the loss of confidence just in the way that third parties, which is really Donald Trump is a third party, and there's Donald Trumps out there in other parts of the world that are politicians that are like him. They're not upholding any political group or party. They have their own money, so they don't have to sell themselves. And And I think that's a sign that there is growing social dissent with our politicians and the way governance is.
Yeah, Dr. K, I would point out that yeah, the Trump phenomenon is not unlike the Bernie Sanders phenomenon, and I think people are just so fed up with the status quo, where they see these government officials living comfortably and living fat off the taxpayer. You know, how do people like Harry Reid come to Congress or the Senate with nothing and they end up with $100 million net worth? How does Nancy Pelosi come with nothing and end up with a 30-something million dollar net worth? John Bonner did the same thing. And I think people are seeing through this, so it makes candidates that might be somewhat unsavory during a normal election somewhat attractive. And you're right, I agree with you 100%. Yeah, people are getting fed up, and it is a sign of the unrest among us. Anyways, carry on.
Also, is while this has been going on in other countries overtly, like in South Africa, there's massive corruption at a very visible level, and the masses really have very little power to control the outcomes of this corruption. In the U.S., it's been going on for a long time, but in a covert manner. And because of the information age we're in, there are more whistleblowers out there now than ever before, at great risk to themselves. But the more that people blow the whistle, the less that the powers that be can do much about it. And the internet's a great tool, a great medium to facilitate this communication between people, between the masses, and between countries. So I think that this covert is becoming much overt in countries like the UK and like the US. I mean, the UK is, I lived in London for a number of years, and I could see the acceleration of corruption over the years I was there. And it's really reached a tipping point of sorts. I don't know how much news out of the UK people get, but Cameron is a disaster, absolute disaster, and he's stripping people of their rights, etc. But this is not a political show. Maybe we'll do one someday, maybe some in the future, but nevertheless, it's disheartening to the masses to see this sort of behavior at such a high level, and see these politicians walk away with a substantial amount of taxpayer money in their pockets. And where did this come from? Obviously the taxpayers are the ones who suffer from it. And it's a reflection of the stock market and where it's at, what it's been doing for the last couple of years. It hasn't really been going higher in a healthy way. These are no longer the trends that we're used to seeing from the 80s and the 90s. This is a completely different animal, market animal that's come alive here. And with that, though, I think we're going to see, with increased loss of confidence, we are going to see increased shorting opportunities. This all obviously will bode very well for the VIX volatility model, which thrives in periods like this. I was saying to a couple of friends that I would love to see a repeat of 2008 or a repeat of 2000 and 2002. These were incredibly profitable times for this model. And because it thrives on that volatility, and on that kind of shorter-term basis, it has a very high predictability in market direction, and this is based on the back tests. And we've seen this year that had I taken every signal, there were a couple of signals I didn't take just because I overrode the model and because of all that experience which worked against me. But there's a very profitable trade, so this year has been very good for the model, and I'm looking forward to what the rest of the year will provide. And on that note, I guess let's talk about some stocks on the short side, because there's some nice setups out there that are emerging as we speak.
Is that my cue?
It can be.
Okay. Yeah. Yeah. I mean, I think the model will do great if we get a nice break to the downside. I would argue, though, that you make a lot more money shorting stocks if you can do it. But I think the MDM gives you a nice, simple way of handling it without having to get your hands too dirty, because short selling can become a very messy affair at times.
Yeah. On that note, what was interesting is when the MDM was utilizing 3x, I mean, anyone obviously can use 3x, but when there were these predictive periods, and this is prior to really, I'd say 2012, when you had Operation Twist and QE3 and all that, which really changed the tone of the markets. The MDM was very handsomely profitable, to the tune of triple digits by playing these 3x vehicles. And then the VBM, the volatility model, fixed volatility model, that what I like about that is it doesn't matter what period you're in. It tends to catch a lot of short-term gains, and those gains can be double digits, and so they can add up very quickly. So I'm looking forward to what the rest of this year has in store, because I just don't think we're going to see a repeat of what we saw, say, in 2013 with QE3. Markets don't like to repeat anyway, and that was a very manipulated environment. So I think we're going into kind of a no man's land territory of higher volatility, which is quite exciting, or can be quite profitable within that period of volatility.
Okay, so let's look at the short side of the market. My experience from a visceral standpoint over the last 2 weeks is that the short side has been the place to be. And it's a lot easier to make pretty decent money on the short side over the last 2 weeks than it has been on the long side. And that's always my first clue that the market is getting into trouble. But I talked about this last week when we discussed the V-shaped patterns that we're seeing in a lot of these so-called ugly duckling formations. Remember, the biggest ugly duckling with over 120% move off the lows was Tesla. But really, what is this? In fact, it is a big V-shaped ascent. And when something, and this is really what the whole punch bowl of death or pod formation is premised on, which is that a V-shaped ascent like this is not sustainable without a period of consolidation. So you get the rally this morning up to the 50-day, stock rolls over and making lower lows as we speak. I mean, you could consider this a short-term cover point, but I don't know. I think at this point you use a 200-day line as your stop. So there's one V-shaped rally rolling over. You look at workday. This one has busted the 20-day. So here's the pattern. We looked at this before, V-shaped. And it starts to fail here. The first sign of a failing pod is almost always a breach of the 20-day line. They'll hold the 20-day line reasonably well, and then when they start to violate and break down, that's usually a sign of trouble. So you see this one actually breaks through the 200-day line on, this is Tuesday, yeah. So now you're rallying back up to the 50-day, so you want to keep an eye on this. Could become shortable there. What I'm actually working on the short side this morning is IBM, and here's another one, not so blatant though, not so V-shaped, but it's big, it's slow. As I was tweeting earlier this morning, this is like a safety short. It's a good beginner short because it's not likely to take off on you, but it's not like someone's going to buy them out. There's going to be some rumor of some huge new development. This morning they announced that they're teaming up with Valiant Pharmaceuticals to produce an app for surgeons. I mean, if that isn't a match made in heaven for a short sale setup, I don't know what is. But you can see here, you've kind of got this fractal head and shoulders. The right side, I guess we could consider this like twin heads or just one big head. Maybe you got a left shoulder here. Here, let me pull out my pen. I love this pen. You got you could consider this like a two-headed beast. And here's the left shoulder, here's the right shoulder. Now you're making a little second right shoulder. Neckline is running along the 200-day line, so you're rallying into the 10-day and the 20-day moving average confluence on a news push. So I mean, to me, this thing's I've been shorting it. Once it got past like 146.70, I think I started putting it out. And I'll just put it out. Here's what I'm looking at on the 620, so you guys get an idea. You can see it's really moving here, and then you get this cross here. But I didn't do anything there because it looked like it might still be able to head higher. I would wait, since the 20 line is not too far behind, I would wait for that to roll over. Now, as you get this stretch here, you're kind of roaming higher, but it's moving higher. The MACD isn't budging. So I'm going to come after it here on this cross, and on the MACD cross alone, okay? And now I'm looking for a break on a 6 period over the 20 period cross, and then I'll go medieval on it. I mean, I'm already up to, well, I guess I'm up to like a 40% position right now, so it could get up to 60 or 70 if I'm feeling randy, but we'll see what happens. Another one I went after this morning was Agrium. These were all the fertilizer stocks have been pretty weak. They're trying to do ugly duckling rallies, but if you look at them from an ugly duckling perspective, they're more like dead ducklings or dead ducks, and none of these have really gone anywhere. I thought pod had a chance last week. I was playing it a little bit here, and you could just feel that it would start to move up. There's no bid in it, so my thinking is these things are weak. They haven't been able to rally. They're probably going to get very weak if the market rolls over. Here's Mosaic. They announced earnings, I believe, last night or this morning. Stock is under the 20-day, so that's shortable using the 20-day line as a guide for an upside stop. But I went after Agrium. I've been watching it. I actually hit a little bit yesterday. Didn't really make any money. Made about 20 cents. Today it's a different story. It's reversing. Got a position there short, and you can see this thing's really gone nowhere. It's almost looking like a little bit of a fractal head and shoulders, even on the weekly chart. And then on the daily chart, you can see the left shoulder of the head. So, I mean, the thing with all these patterns is they look nice and neat, you know, so that whenever you see them, you just start shorting a stock. But the reality is, if they're happening in conjunction with the market weakening, then you've got a little more of the some of the wind in your sails, so to speak. And I think that's where these patterns become very effective. As I like to say, shorting becomes very easy when it's working. I mean, it's almost too easy, because when things break, they tend to break pretty hard, and your short selling efforts will be rewarded relatively quickly, and with some pretty good profits. I mean, the things that really started to break down first in terms of these ugly ducklings. Here's a weekly chart of Alaska Airlines, and of course we caught it on the way up with a pocket pivot. It was good for a trade. You probably got 10-15% out of that at the highs, and then it was running into trouble here, and it broke here. That would have been your sell signal. Why? Because you're breaking the 20-day line. It did it once before, and this shows that even if you see this break, okay, the 20-day line is your stop, and so if you see it running into trouble around the 20-day and then it's able to get through, you might just stop yourself out and then hang back and wait to see if it rolls over again. So this is the idea of being very active in terms of approaching the short side, and being willing to exit and enter again on a trade if it's starting not to work. The reason why you want to do this is that rallies, reaction rallies can be very sharp, and if you get caught in something, it'll just screw you up, and you're better off just going away and then looking to reset. Sometimes you might set up again, you know, 50 cents a buck lower. But the point is not, if you shorted here and you got stopped out, the point is not to make this. The point is to catch this. And you have this beautiful break to the downside from here. So here's your first sign of trouble. And then you bust the 200-day. So you actually, notice how you break the 50-day here. You could have shorted it here using the 50-day line, which is here, as your stop. And then you could have shorted again on this day using the 200-day line as your upside stop. So this thing's giving you a lot of chances to short it. You know, it's rare that you see something letting you short it that readily and that easily, and with these great reference points in the pattern. So, you know, that's one that's broken over, but it started out as a V-shaped pod, really. So let's see if we look at Hawaiian Airlines. Here's another one. You know, yeah, okay, the stock's breaking out. It breaks out here at around 40 bucks. And it runs up, and there's some pocket pivots in here, but yeah, and you get some moves, but you got to figure, you got to be taking profits into a continued rise, because we know in this market they don't last very long. And in this case, you could have gone short this thing right away on the earnings break, because you broke the 50-day, you rallied up into the 50-day here, and now you continue to go lower. At this point, my target would be, initially would be the 40 level, which is the top of the breakout, if you can see here. So let me kind of bring this in for you. I think the highlighter works better for me. And you can see that, what happened here? It's pulled right back into the top of the day. So it's bouncing now, and maybe rallying to the 10-day or the 20-day might make it shortable again. So, you know, that, but that's an example also of an ugly duckling punch bowl of death sort of setup. And but in this case, it breaks out. And the late stage base is probably on the verge of failure. So, if we look at it, here you go. I mean, this is kind of a funky base. You know, straight down, straight up to new highs. You get out there, you really got to be taking profits on that basis alone. and the thing blows apart off the peak. So my guess is you're probably headed for the lows here below 30 at some point. I don't know how long it takes to get there, but if I could short it at the 50-day up around 45.52, that's on the weekly, 45.91 on the daily. So somewhere in there, I might be looking for a move lower. You have Southwest, which was holding up better than the rest of the airlines, and it was actually the last one, I believe, to fail. I mean, it was actually trying to break out from a sort of a V-shaped cup with handle or a double pod. But notice you straight down, straight up. That's the typical pattern, and it's not sustainable. It's just too fast. If it took its time and spent a few weeks, 5, 10 weeks consolidating, maybe it might have a chance at moving higher. You can go back and study, go look at the weekly chart of Cisco Systems, I believe in 94, 95. I think it was 95. It formed a big cup. It had a huge runoff after coming public in 91 and then topped out with the market in, I think, in early 94, and then formed this big cup formation that I think was like 35, 40% deep. And when it tried to come up the right side, it had built like a 5 or 6 week handle. I remember trying to buy it on the breakout, but it failed. And I kept trying to buy it and kept failing. And finally, after about 13 weeks, it broke out. And at that point, I didn't buy it because, I wonder if I can go back that far. Let's see. Here we go.
Now you're right on the years. It was early 95, it kept failing for about 12, 13 weeks.
Yeah, I'm trying to see if I can get back there. Somehow I'm guessing I can't, but we'll see. Let's see. I think I can get there with HGSI, but yeah, here we go. Here's the big cup here. See it? Let me make it a little bigger. And this is your history lesson for the day, okay? So here's your big cup. How deep is it?
Clear pocket pivot on March 24th. And that was
yeah, so see the breakouts here? It's trying to break out here. It's trying to break out here. I don't know. That's not really working for me, at least on that. Let's use the pen now. Back to the pen. The pen is mightier than the highlighter, or is it not? I don't know. Anyways, you can see how it runs into resistance here a couple times, but that's because you've come straight up the right side. So this is a big ugly pod, and you might look at it as shortable, but we were in a bull market. We were definitely in a bull market by March, April of 1995. I remember the Fed raised rates and the market took off. And I remember I had a big client at the time who she wasn't going to buy any bonds until after the Fed. She wanted to buy some bonds because she was trying to put some money away. And back then, actually, you could buy bonds, and they paid interest, believe it or not. You didn't have to pay them interest. But in any case, she wouldn't buy any of these bonds that I had. I thought they were pretty good. They were like 6%, double tax-free, blah, blah, blah. And she wanted to wait for the Fed, and I said, no, the market's going to rally once the Fed comes out. And boom, that's exactly what happened. And in the process, it wasn't until then that the Fed raised rates and Cisco broke out. So what you see here is it really needs 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 weeks. So it needs some time. It's if they're short little patterns or handles rather. Here, let me regroup here. And so we'll go back to Elke. If it's a short little handle, it hasn't put in enough time to go higher. And maybe Love is a similar situation. There's really no handle there, so it breaks. And now you got the stock on the 200-day line. So what I'd be doing here is looking for a rally up to the 50-day line as a potential short sale point. But if you're on this thing and you understand how a pod plays out, and Lord knows how many times I've talked about this in these webinars as well as in the book where I talk about the first, and I think we talked about this in the first book we wrote where we had a chapter on short selling, and then the last book was a full book on short selling. But I talk about this as your first sign of a failure on the right side of a pod, a punch bowl of death setup, is generally going to be a break of the 20-day moving average. And that's pretty much the case with all of these, and you're seeing this across the board. So if you're awake and you're watching this, here's the breakout, and it fails, okay? And just as it fails, it's busting the 20-day boom. You could have even come after it here on the bounce off the 50-day up back into the 20-day line, and it comes apart. And you would have had a strong thesis for doing so because the entire group was coming apart. Look at JetBlue, which is the biggest piece of garbage in the group is still ugly, and Save was another one, and that's still ugly. The only one that did well was Virgin America, but of course they got bought out by Alaska Airlines. So, anyways, to me that group is played out probably short term on the short side, but and you got some other things setting up, like look at Carnival Corp. Here's another one, V-shaped puppy, and you can see again, it breaks out. It looks great on a big Bible gap up type move, but then it fails at the 20-day line, and that's pretty much it. And you bounce off the 50-day, rally into the 20-day, and now it's rolling over. And so there's a short for you. Also, the other, and these were all rallying the other day because there's news of the first cruise ship landing in Havana. Oh, whoopee-doo. Let's all wave our Cuban flags. Actually, today is Cinco de Mayo, but I wanted to point something out to all you dumb gringos out there. I can say that without being racist, So you can slam white people, especially white males over 55, and it's totally cool, okay? But don't come after me because I'm a person of color. Mostly this morning I painted my face this sort of red, white, and green color, so I'm definitely a person of color. But in any case, Cinco de Mayo is not celebrated in Mexico, people. There's only one place it's celebrated in the state of Puebla. My family, which hails from Sonora and Guadalajara, which is where my great-grandparents were born. My grandparents were mostly born here or came here as very tiny children. But they don't celebrate it in Mexico. And I realize I'm going off on a tangent here, but I want to inform people because it really irks me that Cinco de Mayo has been exploited by the corporate food industry in order to sell huge amounts of margaritas, chips, salsa, and avocados. So I don't know. There might be some other things that they sell, maybe jalapeno peppers. I don't know. Ortegas, yeah, that's it, in jars. Good stuff. But I just want you to know they don't celebrate it in Mexico, so it's a stupid holiday. So in keeping with my true heritage, I don't celebrate it either. So, and also I'm not a margarita fan, as everybody probably knows. Dr. K, I think you agree with me on this. Nothing beats a good martini, right? Doesn't matter what holiday it is. So, and if that also scripted, it was. Okay, let's. So where the hell were we? Okay, here's a Royal Caribbean. Same thing. Fails at the 20-day, rolling through the 50-day. Short it using the 50-day line now. Bingo. And you thought shorting was hard. So I'm watching IBM. This is my kind of like my intraday play here for everybody. Get excited about it. I'm even tweeting about it just for fun. But you can see on the 620 you had the cross on the MACD. It's heading lower. I think it's just a matter of time before it reverses. So once it does, I'm going to go medieval. And I mean medieval. So, or maybe I'll go Renaissance on it. I don't know. We'll see. Cinco de Mayo. Okay, no more Corona lights. Yeah, and they sell Mexican beer. Corona, they don't drink Coronas in Mexico either. I don't even think they drink beer in Mexico. The only thing they drink is tequila with a worm in it. And they drink it straight, okay? These people. Anyways, let's continue. Adobe. Okay, Adobe Systems. Here's another one. We talked about this last week. V-shaped. It's trying to form a handle here, but that's so V-shaped, that puppy is going to fail. That's my guess. And I've been hitting this on the short side if it rallies in the 20-day. I'm not short it now. Excuse me. Got a couple of... I'm choking on my own BS here. You've got to rally up into the 20-day line here that might be shortable. And again, it's a V-shaped thing. They come out with earnings, I think, on June 21st. You want to double check that. Don't take my word for it. Oh, here's GoDaddy, and we've been covering this before. They came out with earnings. They gapped down less than $1, and you could have shorted it right at the open at the 30-day line. Or, I'm sorry, at the 30 price level. And now it's broken down through the 200-day line at 29.23, and it's rallying back up into the line. And my advice is you could probably short it here using the 200-day line as your stop. Look at what Priceline did yesterday. It did a similar move, gap down, and let's look at that. There's another one. Oh my God, you notice a theme here? And when I'm seeing this, and I talked about it last week, and maybe the week before, and maybe the week before that, but I've been watching this develop. And you don't know when they're going to break. Are they going to break here? Or are they going to break a little later? Are they going to break here or here? And eventually you get the break. But what is your big clue? Can anybody answer that question? What's your big clue on that? Well, whoops, let me get rid of all these beautiful drawings of mine. If I was 5 years old, my mother would print all these out and put them in an album. So, and I say that because Mother's Day is coming up, and don't forget your mother, you guys. Got that, Dr. K?
I never do. All good.
All right. Just want to make sure.
Acts like the stand-in big brother, so make sure that I'm attentive
my
to
job.
my parents.
That's right. That's right. So I may send her some Sherry's berries. So that's always the
Cool.
easy way out, everybody. And while you're at it, send yourself a box of them too, because they're incredibly good. Anyways, here you go. Price line gaps down, rallies up to the 200-day line. So there's your trade. It's also the underside of this base here. That had formed between late February and beginning of March, or I'm sorry, May rather. And now the 200-day is your stop. So you're seeing a lot of stuff is set up and starting to show up in short sale positions. And you're seeing all these V-shaped pods, or they're V-shaped cup with handles forming, and they're starting to fail one by one by one, and it's just continuing. You know which one I would probably look at shorting? Maybe Panera. It's kind of a funky base. It's broken out. It's holding above the 50-day line, but I'm watching this one, and I haven't got any failure on it just yet. Maybe you're seeing it here, and I'm looking at maybe as short it's going to break the 50-day with the market and become a late-stage failed base. It's never really gone anywhere. I think you pointed this out, Dr. K, that it chop around. Finally, it's breaking out. Go ahead. You were saying? No. Okay.
No, go ahead. That was my phone making a noise saying that
okay.
email.
So I think this is getting a little too obvious, and you've had a 20% move from the breakout point, according to IBD, which now claims to be an expert organization on swing trading. I always remember Bill giving us a bad time, saying, well, you can't tweak the system. You can't tweak the system. The rules are what the rules are, because that's how the market works. It's not my system, it's the market system. Yeah, baloney. Now they've tweaked it, so now they're swing trading experts. But you get a 20% move in my book, you get 15% move in my book from a breakout, you take it. And I've been saying that for a long time, as has Dr. K. So anyways. Let's look at some others. So Workday I'm watching here. This is another one we're watching. It's up $1.22. Still rallying. Look at how you get this little, oh my God, look at this. It's a fractal, a double fractal head and shoulders formation on the 5-minute chart. Do you see this? You got to rally up into the right shoulder. You got a rising neckline. I think you short this using 72.60 as your stop. How's that? Take your profit down at 72. And that'll pay for a whole year's worth of subscriptions to VoSI. So let's see. I'm going to read some questions here because we're getting some. Everybody's saying happy Cinco de Mayo. Look, you idiots, didn't you just hear what I said? I don't celebrate it. It's not a real holiday. It's a commercial holiday. It's right up there with Valentine's Day, and I guess Mother's Day and Father's Day if you think about it. Anyways, Gil, thank you for recommending Damer's book on price action breakdown. Extremely helpful in uncovering additional areas of support, and complements beautifully Ann Cooling's book on VPA and using moving average for support/resistance. You're welcome. I think there's a lot of material. Getting back to the swing trading thing, like suddenly IBD is going to become an expert in swing trading. There's a lot of literature out there on swing trading. And the book that I pointed out last week, Damir, Price Action Breakdown, also Anna Cooling's Volume Price Analysis books. Anybody who's a follower of HCS Investor Software knows these people. But VPA, all this stuff is basically comes from Wyckoff. So, there's nothing magic there. People have taken Livermore and Wyckoff and done things. And like, for example, everybody's always asking me about the shakeout +3, and that's Livermore's old rule. I think if you go back to Reminiscences of a Stock Operator, as well as How to Trade in Stocks by Jesse Livermore, you'll find him, he's talking about that rule. And you notice how the market gets these little sort of frantic little rallies every now and then. It's trying to stay alive. It's like a zombie on an operating table, and they keep hitting it with the defibrillator, and it rallies. But anyways, where was I, Dr. K? What was I talking about? Yeah. So the shakeout plus 3, the shakeout plus 3. But O'Neill changes it now. You have a shakeout plus N, where N is based on the price of the stock. So if it's a $200 stock, it's probably a shakeout plus 10 or something like that. The way I handle a shakeout plus 3 is I use the 620 chart. So whenever a stock, for example, is coming down towards an area, like we can look at something, and I remember I was shorting Amazon down here when it undercut this low. The 620 chart issued a buy signal, and if I was really awake, I would have gone long at that point. But I'll watch this 620 chart when a stock is undercutting a prior low, and if I see a 620 turn, and this you would have seen on this day, I will either cover my short if I'm shorted off here, or I'll turn and go long if I'm looking to get long something on an undercut on a shakeout plus N situation. So that's my improvement on the shakeout buy point, which in Wyckoff's thinking was called a springboard, and you go look at Trades About to Happen is another book that goes into a lot of more modern day detail about Wyckoff-ian techniques. And then you got Livermore's shakeout plus 3. So, you know, it's all similar philosophies and ideas, concepts behind these sorts of setups, but the specifics of these, how you handle them, I think there's varying ways to go about it. And the way I do it, like I said, when I see this occurring, then I'm watching the 620 5-minute chart to see if we get a turn. And if so, then I might go long and then use, of course, the 620 sell signal as a way to get me out quickly if it doesn't work. Okay. Let's see. Here's some others. Nike. This is one I came in short overnight, and it's breaking down for the lows here, so it's down. Skechers, I think we looked at. This is this really is doing nothing more. I mean, you can see this as, I don't know, a hunchback head and shoulders. There's no left shoulder. There's just a big head and a bunch of right shoulders. So it's leaning over to one side like a hunchback. You see that? You guys see that? Here, you want me to draw it for you? Okay, here we go. So here's the hunched back. He's hunched over here. Now here he is, and he's got like a big, ugly nose. And he's got these, like, as he walks around. So anyways, and so you've got all these right shoulders, so are just basically his arm. So it's a head and right arm, or is that a left arm on him? In any case, it's basically in a range here, and it's shortable at the top of the range. And you approach the 200-day line, but you get close to the 40-week line on the weekly chart. And at that point, it hits the gooey kablooey, and it rolls over. And what's our first sign here is a break at the 20-day. In this case, so I'm looking at the 34 level as a short sale point. I've been hitting this one short every now and then, and it comes in a buck, and then you cover it. It usually has its biggest move to the downside over the last few days when I'm not shorted. So I might get a little intraday stalling or something, but it usually has its biggest move when I'm not shorted. That's Murphy's Law of shorting. If you have 3 stocks you're going to short, and you short 2 of the 3, the third one that you didn't short will go down the most. That is been proven. I proved it many times, actually. Here's UA. This is the one. I mean, I was messing around with Skechers and Nike, okay, and this is the one I didn't short. I think I may have shorted for a few points in here, down to like on this day, I forget. But you notice here again, it's kind of a V-shaped move, and we looked at this on the. I pointed this out when it was breaking out. I mean, you could have bought the BGU, okay? It's a doable trade on the basis that it's a BGU, and you use the rules of a BGU as your stop. So the low is 46.15. It kind of cuts a little bit under there, but by less than 1%. So you could have given it a little slack there. But on this day, now we're starting to break. So you see that, then you see a rally back up to the BGU low. You could short it there, and then boom, what happens? It goes through the 20-day moving average, and that is always your first sign of trouble. This is really kind of a weak pot if you think about it, because it's very V-shaped, but it never really gets very high in its pattern. So in a way, you could think of it as a big lopsided head and shoulders. Here's your left shoulder over on this side, and you've got your head right smack in the middle. and you get a big head, and then you get this big ugly right shoulder, now you're rolling over it. But what is your first clue regarding its ultimate demise? And that is the breakdown through the 20-day line. So it's pretty common. So this is what you're watching for on these setups. And I think I've discussed this for the last 2 webinars. So if you weren't on them, recently, then I think you only have yourself to blame. Any other questions? No, you guys are probably all wondering what Cinco de Mayo is still. Let me see here. Here's another one. Okay, Palo Alto Networks starting to blow. Now here's where it broke the 20-day line, and that was the end of the rally there. But you see this same thing. It's a very V-shaped move, and I think we pointed out that this was rallying up to the 40-week line and into the underside of this area of consolidation in here. So this area in here becomes like resistance, but you also have the 40-week line coincides with the 200 line, and you have a very V-shaped move, and now you're breaking down. And you can even see it's pretty clean on the weekly chart. You get a break from the 40-week line here. Then you rally back up into the 50-day or the 10-week line, 50-day moving average there. And then now it's rolling over. So if we look at this is what it looked like on the daily chart. But I think once you got this rally back up here and it started to falter at the 20-day, now you're coming after it on the short side. Now it's cutting loose. So not looking too happy. But again, it's another formation like this, and they're all over the place. And they've started to break down over the last week to 2 weeks, and this has been your first clue that this market has something wrong with it. But in a bear market rally, these sorts of moves in stocks that are broken down leaders, okay, and a lot of these never recovered when you look at the patterns. They have not really recovered. They've just rallied sharply back up in their patterns after these massive breakdowns back in January, February. And that caused them to bottom out. It got kind of worn out on the downside, and you get this sharp rally, and eventually the rally gives way. And if you're alert to it, you're seeing all the pieces come together, all the pieces of the puzzle coming together on the short side, and there it is. And you've got to come in there and test it. I mean, I see it, and you can go and read the book that we just put out on short selling. Well, we didn't just put it out; it's from last year. But these days, when you get older, a year doesn't seem like that long. So it wasn't that long ago. But if you go read that book, you'll see all the mechanics that I'm talking about, and they have held true. Well, the long side of the market hasn't necessarily held true to typical can slim type dogma. The short side still has remained very much as it has been throughout, and I think that that's a critical point there. So we don't have to adjust our methods there. The only thing I would say is that you are vulnerable to these QE-induced or news-induced snapbacks, but that's why you're taking an active approach, a day trading approach at times, or a very short-term approach, keeping tight stops to guard against that, because that's always kind of been the case. Go ahead, Dr. K.
I was going to say that short selling in all its forms, at least since I've been exploring it, studying it, I used to actively trade in it from time to time. That saying that stocks take the stairs up, but the elevator down. These days, it's more like the trap door. In other words, they tend to fall very quickly, which makes the short sale very simple. But in this kind of QE environment, they might find a floor faster than they would, say, a decade ago. So it's imperative to be proactive in covering and taking your profits when you have them, especially on the short side. And whereas on the long side, we need proper trending markets. We really haven't had a normal trending market since late 2006, and then we had one in 2003, and then prior to that it was through the 90s various years, 80s various years. But the point is that we haven't had normal trending markets. They've been very far and few between, and this QE environment hasn't really given us that kind of thing. So that is partly due to the death, or wholly due to the death of Can Slim, where you're buying breakouts and hoping for a nice return on your money. For every 10 stocks you trade back in a good Can Slim environment, you might hit 1 or 2 that are double, triple, or home run stocks. So in this environment, you're just not seeing it, and therefore, the long side, we've had to adjust our approach, as our listeners know, our members know. readers know about that. And the short side, on the other hand, remains that in spirit it still works, whether we're in the 80s, 90s, or now, because fear is a very visceral emotion. And the only difference between now and then is just the timeliness in taking your profits, and you have them, is even more critical today because of the QE floors that come into play very frequently in this environment.
I have a question here from somebody regarding your 620 chart. Do you look for the signal from one MACD or moving average to come before the other, or just have one be confirmed by the other? Either or. I mean, I don't use it as a trading system. There's some thought behind it. So IBM is back up. Well, it got above 147. I just keep hitting it at 147, I guess. But I'm looking for a lot of different things. It's not a system, so it's not like, oh, MACD cross, volume or a moving average cross, short stock, without thinking. I'm using it. I watch the way stocks trade around these, and I get a sense of how they tend to act. And so you can see very clearly what you have here is the MACD making a high, and a lot of times it's just the MACD making a peak will get me to go short the stock depending on where it is. In this case, I didn't take a short here. I got short stock up in here, and now it's bounced off the 20-period line. Excuse me, and it's trying to make a new high. But my thinking is with the MACD weak here, I'm looking for confirmation perhaps from here. But I use it more or less as a guide, and if I see the MACD lines weaken up here at a peak, so you notice it's not making a higher high, and it starts to roll over right off the peak, then I may come after it up here. It doesn't mean that I'll sit there. I always have an idea of what my maximum tolerable loss is in any position, and where I'm going to bail. I mean, on this one, if you're shorting the stock at like 146.80 up to 147, somewhere in there, there's really nothing conclusive yet. What'll happen is it'll just sit there all day, and then you'll become bored with it, and then you'll cover the position at either a 10-cent profit or a 10-cent loss, and then in the last half hour it'll blow 5 points to the downside. So that's how Murphy's law of shorting also will work. But in any case, if you're trying to use a 620, sometimes the signals are clear, sometimes they're not. So here's Google. Okay, gave you a 620 signal, which you could have shorted. Now it's trying to rally back up. I don't know. I think the turn here down around 711 is good for a quick trade, but it's like trading a stock from 71.60, from 71 to 71.10 to 71.60 is 50 cents. So it's pretty minimal. So I'd be looking for this one to fail, but what you might look for here is a second 620 sell signal. I got short this thing here on the bounce right off the opening, just because you were pushing up into the 200-day line. Actually, if you go to GOOG, you're actually right at the 10-day line, and you're just above the 200-day line. So the two are a little bit different. But to me, I short the GOOGL because that's the only one I can borrow. For some reason, I can't borrow GOOG, but that's fine. Either or works. In this case, I'll look at both charts to figure out where I want to short it. And it might get up to 718.96, but the thing is, you're shorting, so for example, if you're going to short 5,000 shares of a $72 stock, you would short 500 shares of a $715 stock. So you're comparable, so you're not getting yourself, or whatever percentage position size you want to take on the short side, so you understand where your risk is if you're wrong, and where you're covering, and how much you're going to lose, blah, blah, blah. And so you do it that way, but and so you have to keep the movement in that context as well. It's just like a tiny, 710 to 720 is 10 points, but within the context of looking for a broader move to the downside, it's pretty minimal. And it may not happen today. It may take you may have to work this a little bit longer, but I've seen some stocks bust a 200-day, rally into them for a few days, and then boom, they break again. And my guess is if the general market starts coming apart in a big way, then that's probably what this is going to do. And there's also Microsoft. Here we go. It's rallying up to the 200-day after busting. This was a shortable gap down. We talked about it here 2 Sundays ago. I think we sent out a report on the 24th of April. Now you're rallying back into the 200-day line, so you got to keep an eye on that. Another one was Netflix. It's so far down there, and selling volume is drying up, but by the same token, so is buying volume. So it's almost like in a little bear flag here. You're looking on a weekly chart, and you can see this thing never really recovered. it was doggy even as it was rallying, and everybody's making a big deal about it. I've heard a lot of people on the TV talking about Netflix as one you have to own for the long term. And when I hear that with Netflix, I'm thinking, this thing could be a $30 stock someday. They're in a highly competitive space, and a lot of people are expanding their offerings of online entertainment, such as Amazon Prime, and you've got Hulu is another one. So I think it's, it's been a growing space, but you're starting to saturate, and on a global scale, I think there's a lot of competitors out there. Somebody says, I don't recall reading anything in your writings about options. I don't use options. I don't know. I mean, you could use options, I guess, in lieu of shorting the actual stock. But no, we don't talk about them. So I like that sound, Dr. K. It sounds like you had jets overflying. You are in Israel right now, aren't you?
Yeah, and it is Holocaust Day.
Somebody's asking, is the IBD in trouble? I saw they discontinued the daily paper and now only have a weekend paper. Yeah, they laid off 40% of their staff. I had a friend who got laid off. Yeah, they're in trouble because they're very narrow. The whole thing is built around a system, a narrow system that isn't working. And the markets are changing and they're not evolving with it. So they've lost a huge number of subscribers. But I would argue the whole investment industry is under pressure because people have are losing interest in the markets in general. I guess we're somewhat lucky. We have a steady stream of nut jobs who like to trade, so they're always going to be there. But your average investor who's attracted to IBD and the notion that you can buy a magic stock and make tons of money. Kind of like, has anybody seen these new ads that are on TV? I forget who it is. Is it Interactive Brokers or Ameritrade or E-Trade or somebody? Like they had two moms pushing their babies in strollers, which I thought was incredibly sexist because it assumes that women are the sole caregivers to children. Why not have one mom or two moms and one dad, and then an LGBT couple pushing another baby? Okay, and so, just to keep it, even. But in any case, the mothers are talking to each other, and one of them's telling, "Oh yeah, I was trading this morning, and I made a cool, I don't know how much, some amount of money, but now she's spending a couple hours in the morning trading to make some extra money." So it tells you, number one, how bad the economy is when the brokerages are trying to pitch people on trading as a way to supplement their income. And as Jesse Livermore said, do not try and make the market pay for your luxuries. And I just thought the whole idea that, oh yeah, open a trading account, and if you're a stay-at-home mom or a stay-at-home dad, you can just spend a couple hours in the morning trading and make some quick money. Yeah, and while you're at it in the afternoon, after lunch, you can head over to Vegas and go play the poker tables for a couple hours and make some extra money, and you can pay for stuff. Yeah, bunch of BS. Somebody says, very well said about the 620, but I think that overall it just shows you that the investment industry now is trying to get people to view trading as an easy way to make money, which capitalizes on the idea that people aren't making very much money at regular jobs, and it helps them potentially bring in new clients. So anyways, very well said about the 620. Some stocks work better than others. That's true, and so you've got to kind of get a sense of how they work and how you can work them. Candles have become another tool for me, adding to the 620. I think candles are useful. You can see that on my daily charts. I actually show the opening and closing tick, so it also gives me a picture of how these things are opening and closing. And I do that. I have that with my HSI chart. So those are like candles. They just don't color the candle depending on whether it's up or down or fill it or whatever they do. But it's essentially the same information, and for me, visually, that works. Would you ever consider staying with a short-term long again? I remember you nailed Apple in 2012. Netflix looks like a similar situation. Yeah, you don't have to take an active approach like I do. But remember, I've made almost 100% in a single month short selling. I've also lost 30 or 40% in a single month short selling. But that was back in the days before I had figured out risk management the way I have now. And once I did in 2010, I was able to test out my methods and make something like 80-something%. I think it's in the new short selling book in 1 month. So, and I do that by optimizing and getting in very heavy on rallies and then covering a portion of the position as it breaks down. But yeah, you could take a smaller position if you get a great entry point, and you can sit there going for a longer term objective. So let's say you were awake and you shorted Netflix on the shortable gap down here. you could hold, as if you use the high that day as your stop, or even if you wanted to give it 6% on the upside up to the 200-day, you could sit with it short with the objective that you're either going to get to this low or even down to this low, over the longer term. And of course, in 2000 to 2003, that strategy worked very well. I actually did it with stocks like Microsoft and Broadcom and Cisco, and I think maybe even Qualcomm. I'm trying to remember, but I did pretty well shorting in 2001. And a lot of the stocks, I would think I was only like 35% short the whole time, and I made about 30% net, and it was basically by sitting there. And yeah, it can be done. These days, I'm trying to hit home runs, and optimize, and I know I can because I know how to go in heavy. I have the tools to go in heavy and keep myself out of trouble now. It's taken me a good 20 years to get there. Well, let's say I figured it out about 5 years ago. So a good 15, 16 years once I started shorting. 5 years into my career to really get that part nailed down. And I hope that the new book, where I discuss it in detail about how I handled it on the aggressive side, helps people shorten their learning curve and not have to go through some of the mistakes that I went through, learning how to handle the risk that is inherent and much greater, I would say, on the short side than the long side. So hopefully the book helps pass that along, and it's useful to everyone in that regard. But yeah, you can take a longer term view. There's just a ton of stocks out there that are just breaking down one after the other. Let's look at, here's Baidu, V-shaped kind of rally, and it's broken down. Rally to the 50-day might be shortable. So you look at that. Look at Biogen. I thought this, the biotech group looked like it might come off the lows it was starting to, but it's come apart, and now it almost looks like you got this giant head and shoulders. Can you guys see that? This giant head and shoulders in Biogen, and it's heading a lot. Whoops, we got to take that out now, and that screwed everything up. Okay, erase all drawings. Okay, you can see now, giant head and shoulders, neckline here. This thing could go down there if it breaks. So these are all, in my view, starting to pan out, and they put in the time chopping around after we had the break last summer, and then again into February. Some have a steep break in July, August, and some have a steep break a steeper break, I should say, in January, February. Biogen isn't one of them, but there are others. You can look at like Netflix, the way that thing broke down. It had a steep break back in July, August. Let's take a look here. And then that was a pretty good, this is where it kind of broke down, and then it didn't really bust apart until January, February. So the biggest part of the move here was in the beginning of the year, and that was a nice short on that basis. I'm noticing, well, IBM isn't going anywhere. The Agrium is the other one we talked about. That's coming apart, but you had a pretty clean short signal right in here. Is this around the opening time, 720? Yeah, I guess so. And it's just coming down. Boom, boom, boom. Now we're down at 85.07, 85.03. Anyways, any other questions here? But I would encourage everybody to look through all the stocks that have had very sharp rallies. And there are tons of them, and they're all breaking out. Look at VeriSign. This is a beauty. This is a nice. Notice how it's had a big run, okay? And now you get into this V-shaped cup with handle, and now it's starting to fail, and you play it that way. Notice back here you had a big sort of a big pod-like formation that failed a couple of times, and it did eventually break out, and that was probably a function of the market. But you play them while you play them, and in this case you reversed on a big breakout failure. So it's a late stage breakout failure here, and whoops. And here's where it is here, and now you're coming down. Notice though on the daily chart that here's the reversal, and now you rallied once into the 50-day line on Monday, and now you've continued lower. And you're sort of undercutting the lows of this pattern, so you are susceptible to a potential rally. So I would definitely keep an eye on that, because if it rallied up to, say, the 20-day, which I think is at, what, 87.93, or as high as the 50-day at 88.34, that might create an optimal short sale point. But again, you can see that your first clue as to trouble is when it blows through the 20-day line on a big V-shaped cup. Or I'm going to call this a pod. This is definitely a punch bowl of death. So anyways, let's see, cost. Somebody said look at cost. Yeah, I mean, that looks like a Head and Shoulders too. I guess you call this like left shoulder, head here, head shoulder. They're all over the place. And a lot of well, I guess there's some heavier selling here on the. It looks really weak. You even see a fractal Head and Shoulders, but yeah, they're all over the place. So I'll leave you with one final stock, and that is Facebook. And I'm actually short a little bit of the stock here. Why? Because I'm crazy. First of all, well, I don't know. It reversed off the highs this morning, so I thought that was a good. And I noticed the MACD didn't do any real budging, so I just decided to hit some here. And I've been working it back and forth. It's actually really fun to day trade. You can day trade it for 50 cents at a time almost. And now it's kind of, I think it's probably going to roll over from here. But what I would be watching for is that we've seen stocks that have broken out, reverse, and blow up. Okay, we saw Netflix do that in January. We've seen other ones. Google did the same thing recently. It looked like it was going to break out, reverse, and blew up. Facebook broke out on a big, I mean, that's kind of an ugly formation. So it's broken out of this weird cup with handle. And that's a little too obvious. So I'm watching, it's in this range. If it breaks and starts to break down, then I think this market is really in trouble. And I keep testing it just because I want to have a visceral feel for what it's doing, because I think it holds the key to where the market's going from here. And when it breaks down, the market's really coming off. McDonald's another one to watch as well. I mean, money is piling into this, and I understand why. They're looking for safe places to hide for now, and that's what you're seeing. Because you're also seeing the utility index rallying, yet the dollar's rallying, okay? And gold has been selling off. But gold to me just looks like it's pulling back in its breakup. But you can see the utilities index hit a new high this morning, is reversing slightly. Gold, on the other hand, is coming in, but if you draw a line across the highs here, this is a trend line breakout 6 days ago, and that looks like it's holding up. And I think it eventually probably goes higher. But the other thing to keep in mind is that even in 2008, when the market blew apart in October of 2008, gold, which had been doing well, suddenly blew apart as well. Let's go back to that wonderful period. So if we look at it, gold is actually looking pretty good, but just before the market blew apart, it blew apart. And so, or that's silver. If we show gold, it'd be the same thing. But right, Dr. K, you remember this?
Yeah, they hung in there better than other vehicles, and then finally they gave ground to because everything got pulled in.
Yeah, and everything just blew to pieces. And it was, if you were short, it was a beautiful thing. So, anyways. I think the picture is pretty clear. It looks pretty negative. Now, the market could rally. Okay, the S&P is sitting just above the 50-day. So the question is this thing getting ready to blow through the 50-day, or is it going to bounce and try and rally to higher highs? I think you stay flexible, but the objective evidence based on what you're seeing in individual stocks tells you that we're probably leaning to the downside here. And any rallies, any continued rally, would not be anything more than a shorting opportunity. And I've showed you a number of stocks that are in positions where they could rally up into resistance, so hopefully you've been taking notes. There are some stocks like Tesla we put out this morning in the pre-market report. Hopefully you guys read that. I know most of the time, it's pretty bland. It's like, yeah, yesterday the sun came up and the sun went down, and we ate dinner after we had lunch, which we had after breakfast. That kind of sort of perfunctory sort of stuff, but most of the time it's pretty mundane. But if I'm going to see something on the opening that I think might be a short, it's going to go in there, so you guys want to keep an eye on that in the morning. Anyways, that's all we have, and I think we're done. Dr. K, are you done?
Yeah, all set.
All right. Anyways, you guys, hopefully you got some fodder for your trading quiver or whatever, or some ammo for your trading gun, or whatever euphemism, metaphor you wish to use. Hopefully you got some good ideas, and we get a sense of where this market's going. And as always, if you have any questions, feel free to email us. What's the email address where we answer questions, Dr. K? Is it dumbquestions@virtuousselfishinvesting.com?
We haven't put that one in yet, but that's a good one.
Okay. How about intelligent questions at VoSI.com? What is it? Info at virtueofselfinvesting.com or subscriptions at support? Support at virtueofselfinvesting.com, correct?
Yeah, info's fine. Info at virtueofselfinvesting.com.
All right, you guys. Unless you know the address. If not, you can figure it out. Cinco de Mayo at virtueofselfinvesting.com. How about no Cinco de Mayo at virtueofselfinvesting.com? Anyways, I hope you guys have a very unhappy Cinco de Mayo, and just remember it's commercialized BS. Don't fall for it. On that note, have a great weekend. We'll catch you guys next week. Take care.
Everyone.